having your daily buys, knowing the next target alone isn't enough. Because on top of that, you also need to have a good delivery. So there's always two components to price action and to a winning trade. First of all, it is a daily buys, so knowing the next target. But second of all, it is also, is the delivery good enough to actually provide a winning trade targeting the next targets? So for example, what do I mean by that? Well, if you have this low right there as your target, that doesn't automatically mean, because you know the next target, that you're also going to take a winning trade. Because if we, for example, consolidate, have a lot of liquidity sweeps before we actually continue lower, you might take a loss before we actually deliver to the main targets. So there's two components to it. It is knowing that this low is going to be the target, but on top of that, it's also knowing if the delivery is going to be good enough to actually take a winning trade, to continue lower, hit the take profit first before we hit the stop loss right there. So how do you go about this? And this was especially visible in this past week on the indices right here on ES and Nasdaq in general has been for a long period of time, but also has been the case on, for example, the dollar this past week, where we are just consolidating and we're not going anywhere. So you can know the next target, but if the delivery towards that next target is just very bad, then you're still going to take a loss, even though you know the next target. So how do you go about avoiding that bad delivery, and how do you capitalize on the good delivery? Well, what is quite important to understand is that the market is made up of momentum. And that's the answer. The market is made up of momentum. That's essentially the answer to the question right here. Now, what do I mean by that? Have you ever thought about the fact that there are different types of trends in the market? So sometimes the market will just explode higher, like this, with no signs of creating any retracements. Other times, the markets will actually create tiny retracements back into, for example, fair value gaps right there and explode higher again. But tiny retracements. Now, other times we will actually create deeper retracements to then continue higher again. Other times we will actually create very deep, weird retracements, liquidity sweeps to then somewhat still continue higher, but it's struggling to continue higher. And then on the other side of the spectrum, the last one, the most extreme right there, is we are just consolidating right here. Now, when you look at these 5 different trends, what pops out? To me, momentum. It's all a momentum story. So what do I actually mean by that? Is that this first trend all the way on the left right there is where we are, for example, 100% bullish at that moment in time, and we are only 0% bearish, or only we are 0% bearish. That means we're not creating any retracement and we're just exploding towards one side of the market. The way I want you to see this is that the market is always having a scoreboard of momentum. So there's always, of course, we can only divide 100%. And that 100% needs to be divided between the bullish and the bearish side. So if we are 100% bullish and we see that in momentum, then we are just exploding higher and we don't create any retracements. That's oftentimes when you, for example, also have those breakaway gaps where we don't create any retracement and we're just exploding higher. So that, for example, is a ratio of 100 to 0 right there, that first trend. Now, the second trend is where we are still very bullish, but we are just about bearish enough to actually create some retracements to then continue higher again. That's oftentimes even a better trend, where the second trend right there is where we might be 90-10 right there. So 90% bullish, 10% bearish. And the 10% causes us to create those tiny retracements to then continue higher. Now, you'll see where this is going, because if we keep this up right here we might say, okay, well, we are 70-30 right there. 70% bullish, 30% bearish. So we actually create quite deep retracements before we continue higher. Now, in order for the market to move anywhere, one side needs to be stronger than the other, right? That's just very basic momentum, arguably, because in order for price to move lower, to continue bearish, the bearish side needs to be stronger than the bullish side. And the bullish side needs to be weaker than the bearish side at that moment in time. If both are equally as strong, we're not going anywhere. The tug of rope game, for me, sums this momentum thing up perfectly. Because in tug of rope, there's 2 teams pulling on a rope. Now, of course, they're both trying to win. So they're trying to pull the middle of the rope towards them right there. Now, if both teams are equally as strong, that rope, that middle right there, is not going anywhere, right? So one side needs to be weaker, one side needs to give in, or one side needs to be stronger in order for that rope to move somewhere. Now, if we understand this right here, and we go back to the price action, then we see the same thing, for example, with these different trends. So here we get from, on the left right there, 100 to 0. On the right, we go to more 50-50 right there. When we are 50-50, we are consolidating. We are not going anywhere. Where in the middle, we might be 60-40 right there, which creates what I like to call a consolidating trend, where we are 60% bullish, 40% bearish, which creates this weird dynamic of large retracements and liquidity sweeps, but we're still somewhat moving higher. 50-50 is where we are just consolidating. We're not going anywhere at that moment in time. So there's two extremes right here. 100 to 0 right there, that ratio, where we are just exploding towards one side. And we also have 50-50 right there, the other side of the extreme, where we're not going anywhere because we are consolidating and because the momentum at that moment in time is equal. Now, why is that important to understand? Is because consolidations right there and bad delivery doesn't happen out of nowhere. It's not random. So oftentimes there's signs, there's a spectrum right here, there's signs that lead to consolidation. It's oftentimes very much cause and effect. So the cause is momentum, we have disturbance in momentum, as I like to call it. The effect is that disturbance in momentum leads to us getting closer to equal momentum. So we are getting 50-50 in momentum. And that leads to then a consolidation, if that makes sense. So that right there, there's always signs to bad delivery. So how can you then start recognizing this? Okay, well, for example, if we are exploding higher right here, and now we do start to create retracements right there, well, then we could argue it might be 90-10. So the more retracements we, for example, create in a bullish trending market, the more signs we get that the bearish momentum is getting stronger and stronger as well. So how do you look at this? Okay, well, let's focus on a couple of examples right here. If we actually take a look at ES right here, I think this is a very good example. We take a look at this bearish fair value gap right there. We have a bearish fair value gap, but on top of that, we also have these bullish fair value gaps right here. This is the effect eventually, the consolidation right there. Now, what is the cause of that consolidation? We can always retrace the steps to the start of a consolidation right there. Well, here on the 4 hour, what we actually see is that we eventually trade into this bearish fair value gap right there. Now, if the momentum was truly super bullish, what should have happened at this moment in time? Well, if the momentum was truly super bullish, if we were that 100 to 0 ratio, then what should have happened? This next candle just explodes higher, right? If the momentum is truly that bullish, then we are just going to explode higher in the next candle. Okay, well, the momentum is clearly not that bullish, but it's not too bad overall at this moment in time. But if the momentum is now, let's say 90 to 10, okay, well, what should happen at this moment in time? Well, we can potentially have a simple sting back into this fair value gap to then continue higher again. We would still be very bullish, if that makes sense. So what we see right here is that the first candle actually does not create a rejection. When we retrace back into any support or resistance level and the first candle is not a rejection, well, what does that tell you? What is the detail behind it? Well, the detail behind it is that you could also think of that as nothing, but the way I see it is, well, it takes us longer right now to actually reject from this support area, that bullish fair value gap. So that tells me that, well, the bullish momentum is not that bullish, because if the momentum was truly that bullish, we would have never retraced back into the fair value gap. If the momentum was a little bit less bullish, but still very bullish, we would have had the first candle right there being very, very aggressive rejection to continue higher again. If we are a little bit less bullish than that, well, then it takes a second candle actually right there to create a rejection right there. And you could even argue that the second candle has a long wick at the top. So it's taking a third candle right there to create a proper rejection to potentially continue higher again. Then how bullish are we truly at that moment in time? So what we see right here is that we do eventually continue higher right there. We struggle, but we do eventually continue higher. And once we start reaching these highs right there, those swing highs, we see that we are struggling to run those highs. We see that we are rejecting from those highs, that a lot of bearish momentum at that moment in time is entering the market right here. So what is happening right now is that the devil is in the details, if that makes sense. It's so important to pay attention to those details right there, because we see that the candles are just struggling to continue higher and continue lower right there very early on already from this bullish fair value gap. And if we go down the time frame, you can see this even more clearly right here, because what we see is that we retrace back into this bullish fair value gap right there. We try to push higher. So far, so good. We create these large retracements right there. Again, think about what would the utopia, what would the ideal, the optimal scenario be if we were truly super bullish? Then we wouldn't even create retracements in the first place. If we do create retracements, it's going to be small retracements to continue higher again. So the larger the overall retracements we get right there, the worse it overall is, if that makes sense. That's not something we don't want to be a part of, because that right there disturbs the momentum, where we go from that 100 to 0 to that 50-50, if that makes sense, because we have disturbance in momentum, as we like to call it. Now, to give you another example of this right here, because this happens very, very often. And again, some people get caught up in it. For example, right here, if we take a look at ES, this is overall, or was at that moment in time, quite interesting to continue lower for a brief moment in time. Now, what we actually see right here is whilst we try to continue lower, and if we go down the time frame to the 5-minute even, we see initially we have not too bad of a trend to potentially continue lower right there. So we could potentially continue lower from the fair value gap that we might create right there. Again, if we are truly bullish, what should happen? Well, if we are truly that bearish, what should happen? If we're truly that bearish, we should never create a retracement back into the bearish value gap in the first place. We would create a breakaway gap to continue lower right there. That's quite important to understand, because that changes the dynamics. So now we do create the fair value gap, and we actually have a very long wick at the bottom right there. That's if you're familiar with the third candle in the fair value gap right there, that tells you that there's a lot of bullish momentum going against you right there. So that disturbs the overall bearish momentum. So it's very likely that then sooner or later right there, when we have bearish momentum and bullish momentum, here we are very likely to create somewhat of a consolidation, because there's disturbance in momentum. Now, until that clears up again. So until we do create bullish value gaps again, those bullish value gaps, we have simple retracements back into them to then continue higher again, which we'll see it's not happening anytime soon right here. Happens only, well, quite late. You could argue it doesn't even happen, because we keep consolidating right there. We have this consolidating trend to continue higher right there. Once we create new fair value gaps, and those new fair value gaps are actually holding decently overall, then that's exactly the moment where price action delivery does clear up a whole lot more. A good example right here, and another example of that disturbance in momentum, is what we see in the dollar right here this past week. So what we see on the dollar this past week is that we were just consolidating a whole lot right there. Now, this consolidation is something that in MMT we've been mentioning actually for quite some time right now, because, well, quite frankly, we saw it coming. And the reason why that is, if we zoom out to the weekly time frame right here, we see that we have a lot of bearish momentum right there. When we create this that bearish fair value gap, and we have a lot of bearish momentum right there, at the same time, same thing here, we now create this long wick right here, a very bullish up candle right there, so aggressively moving higher. So we have a lot of bearish momentum, a lot of bullish momentum at that moment in time. The market doesn't work like that. If the market needs to move somewhere, either bearish or bullish, one side needs to give in. One side needs to be stronger. So if we were truly that bearish right there, we wouldn't have created such large retracements, if that makes sense. We would have already continued lower. So here, when we now create these large retracements right there, what happens? Okay, we have bearish fair value gaps. We also have bullish fair value gaps right here. This is where we try to push lower from the bearish fair value gaps. Once we retrace back into the bullish fair value gaps right here, we try to push higher from the bullish fair value gaps. Once we now try to continue lower again, we also try to continue lower again from the bearish fair value gaps right there. So the way you can see that is that those fair value gaps, those PD rates in general, I like to somewhat see them, as somewhat momentum shifters. So for example, if we trade back into a bearish fair value gap right there, there's a chance that the momentum will shift bearish again. If we trade back into a bullish fair value gap right there, there's a chance that we will trade back into it, and we will actually create bullish momentum again. It's a momentum shifter, if that makes sense. So when we create retracement back into a bullish fair value gap, we can shift the momentum to continue higher again. Now, you'll see the problem, because when we have a bearish fair value gap and a bullish fair value gap right there at the same moment in time, then we have a bearish momentum shifter, and at the same moment in time, we also have a bullish momentum shifter. So that means right there that momentum at that moment in time is equal, because we are stuck. We are stuck between two PDWs at that moment in time, which is very likely to consolidate. So here, anything that happens below this high right there and above this low right there, that is where we are very likely to consolidate. And if you understand, the dollar is not that interesting at that moment in time. The majors are also not that interesting at that moment in time. And this is, for example, a very similar thing. If you actually zoom out on the indices right here, that happens, or that is currently happening. Same thing on the higher time frame, where we are sweeping highs right there. But at the same time, we are also still sweeping lows. In order for us to truly clear up on the indices right here, we need one side to fully break right there. If one side breaks, like we see, for example, on the dollar right here, if we start running these highs right there, or we start running these lows, then momentum will clear up again, because one side is giving in, one side is weaker at that moment in time. That all starts by understanding different trends. So what you could, for example, do is, hey, start identifying the different trends that you have in a market. If you, for example, go to an ES right here, you'll see that previously we actually had very good trending conditions right here, where the retracements back into fair value gaps were not too crazy or anything like that, and we just kept continuing higher right there. Now, eventually, what happened is that the retracements, they got deeper right there, and eventually this turns into this consolidating trend right there, because the momentum is overall shifting from extremely bullish right there to a little bit less bullish, to even less bullish, to now it's equal. Bullish and bearish are equal right there, and we are currently creating consolidation. And that is eventually what leads to a good versus bad delivery. So to top this off, to fully clear it up, what should happen if we want to have a clear delivery again? Well, again, if we take a look at any consolidation right here, any consolidation, for example, what we see right here, this consolidation, again, we ideally want to avoid right there. Now, the way this clears up, this consolidation, is the moment we now create, again, fair value gaps, for example, bearish fair value gaps right there, we retrace back into those and we simply continue lower, and we create another bearish fair value gap right there. We retrace back into those and we continue lower again. That clears up the momentum. So the same way where we went from very bullish right there to less bullish and more bearish to eventually create that consolidation right there, we can also climb the other ladder, right? So we can go from consolidation, okay, the trend looks a little bit better right now, to eventually it's exploding right here, if that makes sense. So that is what leads to retracement into fair value gap. We continue lower, retracement into fair value gap right there. It's clearing up. We're getting better trends. We're getting, for example, 90% bearish, 10% bullish at that moment in time. And then eventually it's just 100 to 0 right there, 100% bearish, 0% bullish at that moment in time. And that slowly changes again right here. So here, retracements right there. And now we create deeper retracements back into, for example, fair value areas, order blocks again. That changes the momentum again. And that is quite important to understand regarding delivery. Once you understand that, you stop taking those losses essentially before you do take, for example, the winner right there. This is why, your target daily buys alone isn't necessarily enough. All right, perfect.